Welcome to Investor Copilot. I'm Viraj, and today we will talk about some macroeconomic fundamentals, some key indicators which we all should be aware of if we have an interest in growing and preserving our wealth. So let's get started. Now, for all of us, a basic assumption or a basic premise is that let's say we have a certain amount of money in our bank account or elsewhere. The rate at which this money is growing should be faster or higher than the rate at which we need to spend it. So this is a basic assumption that we begin with. Let's talk about the first concept, that is inflation. I'm sure all of you have heard the word inflation a lot. Inflation basically defines a concept which gives meaning to the rises in price. So price rise for any goods or commodities or services, etc., is plainly defined as inflation. A reverse concept is deflation. Deflation defines a fall in prices for any goods, commodities, or services in a certain region. Now, inflation and deflation go hand in hand. Currently, we are living in an inflationary economy in Canada and most parts of the world, most countries of the world, as you all know. We will look at the concept of inflation further in this video as well. Second concept we will discuss is a very important one. It's called CPI, that is Consumer Price Index. Now, what is the definition of Consumer Price Index? CPI basically defines the overall monthly rise or fall in prices as experienced by the consumers of a country or a region. So CPI basically defines the growth or decline in prices of a vast variety of goods or services or structures, commodities, anything as experienced month on month by the residents of a country or a region within that country. That is the basic definition of CPI. Now, another term for CPI is inflation rate. So, inflation rate, which is expressed in the percentage, is the same as CPI. We will further elaborate into the concept of CPI later on in another video. And lastly, I want to talk about the third term here, which is purchasing power. What is purchasing power? This is a soft terminology and it means that let's assume you have $100 at a certain point of time and you can purchase X amount of goods with that $100. If you fast forward to a year on and you go into the next year at the same period of time, how many goods or what amount of goods can you purchase with the same $100? That defines your purchasing power. So the power of the money in your hand in terms of how much quantity or how much value of goods or services you can buy is called purchasing power. Now, inflation slash deflation or consumer price index or purchasing power, all three concepts are tightly correlated. In the next video, we'll look at some good examples and some statistical examples which will define all three concepts more clearly and even relate these three concepts to the need for short-term investment and self-directed investment. So stay tuned. Thank you.